Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Valerie Teitel. We're an hour away from the opening trade. Here's what you need to know. President Trump lists rare earths among his top issues with China as the trade truce nears its expiration. Is it Australia to the rescue? We'll dive into it. France gets a second credit downgrade after S&P strips the nation of its AA rating. French bond futures feeling the pain. And President Zelenskiy saying the war with Russia should be frozen before the two sides can enter into peace talks, even as Vladimir Putin continues to demand territory. Val.
We check in on these markets at the start of the hour. It is looking fairly positive for equity markets. We're continuing to rebound from Friday's weakness. We're seeing some outperformance definitely in Asia. There was a catch-up trade there. S&P Futures up 0.4%. Eurostoxx futures up nearly 0.8%. The dollar is slightly softer to start the week, and those U.S. 10-year yields at 4.01. Fixed income looks like it is going to start this week on a weakening track. Our eye is on French bonds when they open in half an hour's time. The countdown to the opening trade starts right now.
One of the things I want is China's going to buy soybeans. I want China to stop with the fentanyl. Very, normal things. I don't want them to play the rare earth game with us.
Well, it's nice that he's told the Chinese what they can and cannot do. You wonder whether or not the Chinese will play the game that Trump wants to play. But we work our way towards this key meeting that may or may not take place between Trump and Xi. Today's data, though, out of China, I think is really interesting in what way it changes the narrative. Clearly, there is a demand issue in China right now, but the Chinese have got a plan, or at least they will have, Kriti, by the end of the week.
They hope to. They're fourth, I believe, in quite some time. Let's go back to the geopolitics before we get to the data, if we can, just a moment, because this is what's so crucial here. This is no longer just between the United States and China. It is dragging in countries from around the world. You talk about soybeans, which the president did in that piece. That directly impacts the likes of Brazil and the strengthening relationship there. You talk about the rare earths piece, Australia potentially coming to the rescue. You pointed that out this morning, Guy. This is starting to become something that quite literally is not just a trade conversation between the world's two largest superpowers, but one that is starting to envelop every other country around the world.
And when it comes to the data, it was just another hint, another glimpse that China's economy is being driven by exports and dragged down by internal demand. Now, with this fourth plenum going on this week, I think it'll be interesting to see which one they try to help, because I don't think there's money to help both. They're either going to aid their export activity, or they're going to try to, again, reorient the economy toward the consumer, things that they have talked about doing before, but it seems not to have yet come to fruition.
There just isn't the domestic demand there at the moment, and that's the problem that China currently faces and continues to face. The housing market, we've been talking about the housing market for years. It continues to slow down. House prices continue to drop. That is a big factor for consumers. Consumers represent the future, you could argue, for the Chinese economy, but they're not delivering at the moment, or don't have the stimulus to deliver. The Chinese authorities have not made that happen yet. Can you continue to export? Well, at the moment, they're just rerouting stuff into other countries, which is ultimately ending up in the United States. Who holds the balance of power in that relationship? I think it's really difficult to tell at this point. Trump's saying basically, buy our beans. We want to buy your rare earths. This should all work out. But I'm not sure the Chinese see it that way at this point.
Well, the Chinese still have to deal with things that are long-standing issues going even back to the first Trump administration, arguably back to the 90s, which is IP rights, which is competition, which is the fact that Donald Trump is trying to invite investment from every other part of the world, not necessarily China, not to mention the technological race that's happening in the background. And I should say the energy security one as well. Remember, China's still a major buyer of Russian oil.
I thought it was funny to look back towards history about how the U.S. boosted consumer demand. You know how they did that back in the 40s? They moved to a 5-day work week. They gave the employees an extra day off in order to spend on things like cars, do things on the weekend. Maybe cutting back on the Chinese work ethic is what they need to do in order to boost the consumer. Follow the U.S.'s example.
That's an idea.
You need to have Social Security. You need to have all the other things put in place to make that happen in the first place. You could argue that
Speaking of taking lots of time off.
This is Val's way of pivoting us to talk about. It was not a good weekend in France, was it?
No, Heist?
The Heist is amazing. We'll come on and talk about that in just a moment. But the Heist, obviously, is the French story that everybody's paying attention to at the moment. The real story they should be paying attention to, and I suspect in around 20 minutes' time we'll be paying attention to is what is going to be happening with the French bond story. The downgrade caught us all on the hop.
Yeah, S&P, an unscheduled downgrade of France, the second major ratings agency now to drop the AA rating in less than a month. So following in Fitch's footsteps. There is more to this story because the last major rating agency, Moody's, does have an unstable outlook, but they are due for a review on Friday. That would be, 3 of the 3, if they do drop, 3 of the 3 going to single A from double A, which I think the market is going to start to speculate could cause some of these ultra-conservative bond funds, not necessarily your mainstream ones, but your more conservative bond funds, to start to reorient away from OATs. Some of these do need an average double A rating in order to hold them in that portfolio, and it is month end next week. So those kind of speculations really could pick up ahead of that.
The fact that Spain and France right now have the certain, not only are viewed in equal kind of standing from the market perspective, but right now have the equal credit ratings from a lot of these agencies is quite telling. The political piece, some of the geopolitical analysis from over the weekend I thought was interesting. That even though Le Cornu had, and I'm definitely pronouncing that name wrong, Le Cornu has currently kind of stood or has some standing at the moment, there is concern that that won't last for long, that ultimately he is on his way out. And, of course, the overarching concern that Emmanuel Macron could quit ahead of time. There could be a snap election that comes even before the 2027. All of that weighing on the French story.
Absolutely. I still think the biggest story out of France over the weekend was the fact that
some jewelry got stolen.
Jewelry got stolen.
Did you see the video? Apparently there's a video circulating of a saw that was used just in broad daylight.
It's amazing. Anyway, we'll see whether it reopens today. I don't know whether the Louvre will be open. It was closed yesterday. There's a lot of tourists, I suspect, that want to go and have a look at the latest display at the Louvre, i.e. probably big closed for renovation signs, maybe. Let's talk about Ukraine. Apparently this meeting in the White House was absolutely unbelievable. The Ukrainians walked into that meeting expecting a completely different outcome. They expected to be talking about what was happening with Tomahawk missiles. They didn't get that. Putin had already got, it seems, to Trump. Trump was apparently, according to the FT's front page this morning, parroting back some of the lines that Putin was using on that call to Zelensky, basically signaling, accept Putin's terms or be destroyed. That's what the FT front page is basically going with this morning. It's going to be interesting to see what defence stocks do this morning. Defence stocks have had a terrible run in Europe over the last 10 days. We've had the worst run, I think, since 2022. I think it might even go back further than that. So European defence stocks, is this a reason for them to bounce? I can't work it out whether or not this is good news or bad news. If you were to think that the Europeans are going to have to step up what they're doing, you could argue maybe it's good news for European defence stocks and maybe they bounce. Maybe they just bounce anyway after such a big downturn. But it was quite the meeting, apparently, and not the one, again, that Zelensky was anticipating.
Well, to your point, Zelensky going into that meeting asking for Tomahawks coming out, at least from the papers that we're seeing. The Washington Post, for example, reporting that Vladimir Putin is still pushing for the Donetsk territory swaps, which we have heard in previous iterations is a non-starter not only for Zelensky but for a lot of European leaders as well. The fact that Donald Trump is now talking, and I should say Zelensky talking about freezing the conflict on current borders before even having this conversation, that is a marked tone shift from that government.
Well, speaking of tone shifts, we got one from Lagarde over the weekend, who has previously been very wary of seizing Russian assets. She was speaking to CBS over the weekend, signaled an openness to using these frozen Russian assets to secure funding for Ukraine only if all global counterparties holding Russian assets move in tandem. But essentially, she seemed open to using these assets as collateral for Ukrainian defense funding. In Europe, they have around $200 billion of frozen assets, and she was claiming that maybe $140 billion could be essentially borrowed against that to help for funding. And I think this is interesting when it comes to the discussion with gold, because one of the reasons that central banks have been diversifying away from treasuries and the like and into gold is perhaps because they saw what happened with Russian assets being seized, and they're wary of needing something in their own vault in their own country. Yeah,
something that doesn't have a counterparty risk attached to it, i.e. the US administration can get hold of it. We've got some great guests lined up to talk about what is happening in these markets. Last week was quite the week. Are we going to see a little bit more volatility this week, or is it all going to calm down? Alfonso Pagatiello, Pananuro Capital founder and CIO, joining us shortly. Alicia Garcia Herrero, Natixis Chief Asia-Pacific Economist, joining us on the Chinese data we've had out this morning. William Sells, HSBC Private Banking and Wealth Management Global CIO, joining us at the top of the next hour. And Andrew Sheets, Morgan Stanley's Global Head of Corporate Credits Research, is going to be joining us. Is he hunting for cockroaches? We'll find out a little bit later.
Well, it is a busy week. Let's get you set up with your trading diary. We do have lots of earnings and a shred of U.S. economic data, so we cheer that one. But today it kicks off, as we mentioned, China's Plenum does begin out in Asia. We also have Trump welcoming Australia's leader to the White House. We are hearing that rare earths are going to be a topic of discussion there. On Tuesday, Netflix earnings. Wednesday, UK CPI, and Tesla begins the Mag 7 earnings. Thursday, we have that EU leaders meeting where those Russian frozen assets are on the table to be discussed. Intel earnings as well on Thursday. And Friday, the shred of U.S. economic data I was mentioning. The delayed CPI report will be released at Friday at 1:30 p.m.
I want to talk... The Australia meeting this morning, I saw it on my agenda and I was like, no. And it kind of passed me by and I came back to it because suddenly it occurred to me that there's two things you want to be talking about when it comes to Australia, one of which is nuclear submarines, of which the US is at the moment trying to figure out how it has enough of them to fight China, and maybe it doesn't want to give them to Australia, part of the AUKUS program, so that's going to be quite a big part of the program today with this Albanese meeting. But the other one is rare earths. We can probably bring up some of the rare earth stocks in Australia.
Gone absolutely nuts.
They have gone berserk over the last month or so, and there are many that have gone berserk, and it's going to be really interesting to see kind of whether or not Albanese can parlay this into some sort of deal with Australia and the United States when it comes to defence, when it comes to security, whether or not Australia can deliver something here, because it does actually have refining capability that others don't at the moment. I'm not sure it can completely offset China, but it's worth paying attention to what is happening in the stock story. It's amazing.
Yeah, and possibly would the U.S. government think about equity stakes in global refineries, global rare earth companies in order to secure that kind of demand? You know, they've made that investment in MP Materials, Lithium Americas. It's highly speculated they can make another one. Perhaps they're looking now on a more global scale to secure their supply chain.
An activist investor no one saw coming. I love that in the entire week ahead, the Australia meeting showed up, even though we have European earnings, tech earnings, and, of course, the US CPI data on Friday.
It's just that's something that I don't think a lot of people will be aware of in terms of the significance of this meeting today. But I think the tech earnings this week are going to be massive. If you look at what has performed in the last month on the S&P, I think the top two performing sectors, and the Journal's got a piece on this morning, healthcare and utilities, top two best performing sectors over the last month, which tells you maybe something about the defensive-ness of this market going into.
Utilities possibly tied to the AI trade, energy stocks.
Also quite defensive, you could argue.
Yes.
But the healthcare story is interesting as well, in as much as the deals have been done. So again, Trump playing a part in all of that. But yeah, it's a massive week for European earnings. OK, let's move on. Let's talk about what else you need to know this Monday morning. A manhunt, we've already mentioned it, underway in France. Several pieces of jewellery stolen and a daring daylight robbery at the Louvre. The museum shut Sunday after the theft. I haven't actually seen whether it's reopening this morning. Thieves broke into the Apollon Gallery, which houses the French crown jewels, stealing 8 objects, including a tiara. There was a necklace, there were earrings, a lot of these with historical significance. One piece of jewellery was recovered during the thieves' escape. Israel has launched strikes against Hamas after blaming the group for a lethal ambush that killed 2 Israeli soldiers. Palestinian officials say 27 Palestinians have been killed by Israel over the last week. Israel has also halted the transfer of aid into Gaza until, quote, further notice. And Japan's ruling Liberal Democratic Party will sign a coalition deal with the Japanese Innovation Party later today, we understand. It paves the way for Sanae Takaichi to become the country's first female prime minister. Japanese benchmarks are amongst the region's best performers on Takaichi's pro-stimulus policies. I'm not sure which benchmarks, but we'll come back and we'll find out which ones are important. It's interesting, there's been some commentary this morning also talking about the fact that rates should go up. One member of the Bank of Japan talking about that this morning. Now is the time to strike, apparently.
Okay. Go ahead.
Well, yeah, no, I mean, we definitely saw strength in Japanese equities with the Nikkei up over 3%. A lot of that does have to do as well with the rebound on Wall Street, but also Takaichi securing that coalition. It definitely does help. The yen is little changed, but we are seeing JGB yields rise across the curve. Those 10-year yields are up around 4 basis points in Japan.
All right, we're going to be monitoring those market moves. Coming up on the program, we're going to dive into the luxury story. It's a luxury makeover. Kering agreeing to sell its beauty division to L'Oreal in a deal valued at 4 billion euros. Plus, of course, as Guy mentioned, we're going to check in on the defense stocks at the open. Donald Trump pushing for an end to the Ukraine war. How's that received from some of the richest sectors in Europe? But up next, the U.S. shutdown continues to weigh on treasuries among a series of other fears. Uncertainties worldwide impacting global government debt. We're going to dive into the details. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
right now, my assessment is that monetary policy after the last ease, the federal funds rate is somewhere between modestly restrictive and neutral. That's a reason why I said that we have to tread cautiously and carefully here, because I see limited room for further easing before monetary policy could become overly accommodative.
That was the Federal Reserve Bank of St. Louis President Alberto Musalem speaking there at an IIF panel on Friday, talking about how the Fed might actually be at neutral and they need to be cautious cutting rates from here. I definitely want to talk about the Treasury market rally of last week. It definitely showed us that Treasuries are a safe haven. They rallied off the back of these China tensions, rallied again later in the week on the back of credit angst around regional banking story. On Friday, we did see a breakout further. We saw those 2-year yields touch 340. Those 10-year yields actually dropped below 395 for the first time since April. We are just drifting higher in yield. We do seem to have some weakness across fixed income ahead of the U.S. CPI report due on Friday. But the real kicker for some global fixed income weakness this time around could come from France. We got a surprise downgrade from S&P on Friday, an unscheduled downgrade, and now the second of the major rating agencies to drop the AAA rating on France in just over a month's time. We are seeing some weakness in French 10-year bond futures, but I thought it was helpful just to give a guide of where these major rating agencies currently stand on France. As I mentioned, Moody's and Fitch, S&P and Fitch have both downgraded them to now to single A with the outlook stable. Moody's has a review on Friday, and this could really be a kicker for perhaps some automatic selling of French bonds, given those ultra-conservative bond funds do need a AA rating. Moody's is up for a review on Friday at the close. They currently have them the lowest rank of AA. They are on a stable outlook, but it does look like they want to catch up, perhaps, or keep in pace with their peers. Guy?
Val, we're keeping a firm eye on what is happening with the French bond market. It's about to open. I suspect you're going to get an opening price in the next couple of minutes. I'm beginning to see my screen beginning to flash some indications as to where we are. Doesn't look like a big move to the upside. That's certainly what the futures are indicating at the moment. But we'll bring you that price as soon as we get a firm indication as to where OATs are this morning and how they're pricing in what we heard on Friday. Alfonso Pecatiello, the founder and CIO at Palinuro Capital, joining us now. An Italian to maybe start a conversation about French bonds. Good morning, Alfonso. Look, we're about to get pricing on French bonds. We'll get some details in just a second, a firm price coming through. But what does an Italian think of French bonds this morning?
Well, it's funny to say that finally BTPs, the Italian benchmark for government bonds, it's actually yielding somewhere closer even through French bonds, something that like 5 or 10 years ago was absolutely unimaginable. It's just the result of political uncertainty in France. So look, at the end of the day, it's all about the budget. As long as the premier that Macron nominated is able to pass through the budget, all of a sudden it's going to be very, very hard to be short French bonds. I was looking at how much does it cost to actually be short French bond versus swaps or versus Germany, something safer. And for a 3-month holding period, this costs investors somewhere around 10 to 14 basis points, which means that you might want French bonds to widen. That's maybe your base case view, whatever, due to political uncertainty. But those bonds need to widen 10 to 14 basis points over 3 months just to basically make up for your negative carry. So it's not an easy trade to hold, and especially if the budget passes, I think a lot of people will have to reconsider their stance.
Over the last week, we've started to see, though, the bond market more broadly. Val was just talking about this. Treasuries back as being maybe a safe haven trade. Does that work for you as well? What are you seeing in terms of where global bonds go at this point? You've got an awful lot of factors to fold in to that narrative. Cracks appearing in the credit markets, maybe. You've got what's happening, obviously, in Washington right now, or not happening in Washington. What do you see in the Treasury market?
I love the question. Look, the negative correlation between bonds and stocks is a function of how predictable core inflation is. If you look at history, every time that core inflation was somewhere around 3%, the negative correlation kicked in again. And this is because the central bank, once inflation goes around 2.5% on a core basis, starts looking at weakness in the labor market as the main driver for their policy making. And so right now, where is core inflation in the US? Well, just around the 3% line. And then it's very nuanced, right? You can say, oh, I'm going to ignore tariffs. They're a one-off price increase. So as Waller said last week, core inflation ex tariffs is 2.5%. There is another camp that says, well, core inflation X everything is 0%. So if you start stripping out stuff from inflation, what are we talking about? But my view personally is that housing disinflation is going to continue further. And if this housing disinflation comes through for another couple of quarters, actually core inflation could be somewhere benign around 2.5% to 3%. And at that point, yes, Treasuries will start acting as a safe haven again. So the negative correlation kicks in all over again.
Alfonso, there were some folks who were making the argument that that timeline, the argument that you just outlined, would hit in the third quarter of this year. I hear your argument. When does it show up in the markets?
Yeah, this is very, very hard to predict. It's basically the behavior of companies. I mean, tariffs are a tax on U.S. companies and U.S. consumers. How the tax gets passed, well, that's up to the ability of consumers to withstand that, and what is the decision making on margins from corporates. It's quite hard. Right now, it looks like about half of the tariffs have been passed to consumers, roughly, but it's very hard to predict what's going to happen next. The consumer as well is very bifurcated. Let's say, Americans that are earning quite a bit, so the high end of American consumers are holding pretty well. The low end instead is struggling quite a bit because the low end is employed by sectors that are actually affected by tariffs. The job creation in stuff like transportation or manufacturing or trade in the US has been flat to negative for quite some months. So I don't think that overall U.S. consumers in aggregate have a huge ability to withstand tariff pass-through, which also justifies why companies haven't done it so aggressively so far.
Alfonso, I want to pick up on something you said there about inflation. You were calling for housing disinflation, and I feel like that's a bit out of consensus. Can you walk us through what is informing your view that we could get housing disinflation? Because that makes up a majority of the U.S. core CPI basket and something that could really drag inflation down rapidly.
Yes, look, I mean, first of all, the way that core CPI measures the shelter inflation or housing inflation is very, very lagged. So basically, the on-the-ground rent inflation, the renewal of rent contracts, if you wish, is captured with a lag from shelter CPI inflation. So the disinflation we have seen on the ground rent indicators, something like the CoreLogic or the Zillow rent inflation, doesn't immediately reflect in core CPI. It takes quite some time. And so my models are basically saying, look, I mean, for the next couple of quarters, it could be that the on-the-ground rent disinflation you saw, basically for the last 12 months, still has to get fully reflected into shelter CPI. It's basically a lag effect. Now, the fun part is that the Federal Reserve is well aware of that. So the Fed knows there is a lag in how they measure shelter CPI, but they have to respond to incoming data. So if the shelter disinflation theory I have due to the lag comes through, they basically have to simply respect whatever the data is.
All right. Alfonso Pagatiello, Polonuro Capital's founder and CIO, joining us this morning. First take on both a little bit of Europe and the U.S. We thank you so much. Speaking of the U.S., let's talk about a point of contention. Rare earths is increasingly becoming that point of contention in the U.S.-China trade tensions that are gripping global markets. ECB President Christine Lagarde weighed in on Face the Nation yesterday.
Well, China currently has leverage against most countries that consume rare earth. And I think on the front of rare earth, the Europeans and the Americans are in the same boat and they're rowing in the same direction.
Coming up, we're going to get the latest on those trade tensions. This is Bloomberg.
Good morning. Where are we? 29 minutes until the start of cash trading for equities here in Europe this morning. You're going to be watching a number of different sectors this morning. Keep an eye on defence. I suspect that's going to be interesting. But the broad story this morning is of a bounce back. There you can see it. We are maybe coming back after a tough and quite choppy week last week with a more positive start to the week. But it's Monday morning, first thing. There's a long way to go this week.
Equities up, bonds down. Clear picture here.
Wow.
Well, we don't often say that, do we? But we are seeing some weakness, especially in French OATs. It does look like we are underperforming their German counterparts by around 2 basis points. That spread between French and German yields is going well into the 80s at the moment. That's as we eye Moody's next review coming up on Friday. Will they drop their last AA rating, the last major standing of the major 3 ratings agencies? Excuse me. We're also seeing an underperformance outperformance when it comes to JGBs as well. So that is also adding to the fixed income weakness. We're 4 basis points higher in the Japanese 10-year yield. And that is off the back of Takaichi coming a lot closer to that ruling coalition to become Japan's next prime minister.
Let's continue our tour around the world and go to what's going on in China. China says its economy is still on track to reach this year's expansion goal, even after reporting the weakest growth in a year. It all comes as a boost from booming exports was undermined by weak spending and investment. Now, the data also comes as China's ruling Communist Party holds its 4th plenum discussing the 15th five-year plan for the economy. Bloomberg's Asia Stocks reporter Bian Sung is all over this. She joins us now. Bian, just walk us through what investors are watching when it comes to this plenum.
Yes, I think the investors who are watching this fourth plenums are really focused on the policies, including technology, AI, consumer, and anti-involution. And also, of course, anything relevant to the yuan globalizations will also be closely watched.
In terms of what we're looking for in the stock story, what are we going to be looking at there? Are there any surprises coming up? Is it obvious which sectors are maybe going to perform around this? What are you looking for?
Yeah, I think technology is a really hot topic right now, but you are not really going to see too much surprises and impact on the share prices because that is already widely expected. But in the consumer sectors, there are some possibilities as the market hasn't yet really priced in an aggressive policy stimulus yet. So if there is any strong policies, that will be a positive surprise, and especially after the lukewarm Golden Week holiday spending and also the slower GDP. That opportunity is already really being boosted. And in the anti-evolution area, for those solar stocks, lithium stocks, those are seen like most likely to have a run, as they are still relatively cheap and the net profit margin are still low, even after their share prices have rallied for the past 6 months.
All right, that was Bloomberg's Asia Stocks reporter Bian Song. Thanks for joining us on the latest out of China's 4th plenum beginning today in Asia. But we're also really interested on what's going on with this rare earth trade. As we mentioned, these negotiations with the U.S. and China do look set to continue in some way. Besant is meeting with Herr Lifeng, supposedly in Malaysia this weekend. We know that rare earths is one of the main things on the table.
Well, Trump led with it. It was one of the key focuses that he's looking at in terms of the 3 things that he's watching out for. Fentanyl, beans and rare earths appear to be the kind of 3 things that he's going to be focusing on. Nice that he lets everybody know what the negotiations are going to be looking like. Yeah, and then you've got this Albanese meeting. The Australian Prime Minister is in D.C. Are you going to see some sort of a deal getting done there? What can Albanese do in terms of touting Australian rare earths? We've seen the Australian rare earth stocks moving aggressively over the last few days into this meeting. Could the US take stakes in them? How will this work? Does this also feed into what is happening with the nuclear submarine deal as well? Because the Australians are a little worried that the US might back out of that and not supply the nuclear subs that have been promised under the AUKUS deal. But maybe actually the rare earth story tightens that all up again.
Well, the pitch I thought was interesting last week in a speech, and this is in our Bloomberg reporting. The ambassador to Washington from Australia said these words: Australia equals the periodic table. The U.S. has a deficiency in 30 to 40 of them, and without much additional effort, Australia can provide them. There you go. That's your sales pitch.
Yeah, so they want to be essentially the key to all of this that will unlock maybe the U.S.'s bottleneck on rare earths. I mean, that could position them possibly in a really good spot with the Trump administration if they could dangle that out there.
Oh, yeah. So we'll see. We'll watch that meeting. I think they're meeting at 11. I think they've got a lunch at 11:45, which seems a little early for lunch, but you never know. Might be a nice lunch. Could go well. Let's talk about what else we're going to be seeing out of this China data in terms of how it's going to affect the European stock story this morning. Consumption is weak. I think that's one of the big takeaways that you're seeing out of these numbers. So keep an eye maybe on some of the luxury names. They could be affected by this, and maybe LVMH moves off the back of this.
And it's such a good week last week.
Yeah, I was about to say, right? A kind of massive turnaround kind of last week coming back. Is that something that could get dinged first thing in terms of the data that is coming out of China on the back of that? The other thing is keep an eye on the auto stocks, which again have been really volatile recently. Keep an eye on the mining stocks. Now, the mining stocks I don't think are this isn't the story around rare earth. This is a story around what is happening with copper and coal and all the other stuff that they produce in Western Australia that goes directly over to China. So I do wonder whether or not actually there is a stock story that you could see being read across quite quite significantly, maybe more into the London market than elsewhere. But I think French and the London markets could be affected by some of this Chinese data this morning.
Yeah, I mean, also when we talk about the open, at least here in Europe, we have to mention the banks could really be rebounding strongly today. I was really shocked to see that Deutsche Bank on Friday's session was still down over 6%, and that was, amid optimism later in the U.S. session. So maybe we're in for those banks at the open coming up with a big rebound. Let's see how that kind of shapes out.
OK, where are we? 23 minutes until the stock market open. There's plenty of stock stories that we are going to be watching this morning as we work our way towards the equity market open. Kering is selling its beauty business. You want to focus on that. So there's two stories you want to be watching out for within the luxury space. Kering selling that business to L'Oreal, we think, as the new CEO, Luca de Maya, looks to turn around the luxury French company's fortunes. Gucci, a big part of that. Anyway, that's going to be one of the stock stories that we're going to be watching into the market open. That's coming up very shortly. This is Bloomberg.
We're 20 minutes away from the opening trade, and futures are pointing higher this morning. Euro Stoxx 50 futures up 0.8%. Some of that is a catch up to Wall Street, but it also was a positive session over in Asia. The MXAP jumping. That has to do a lot with what's going on in Japan. It does look like the ruling coalition, the LDP, she will become the next prime minister due to this coalition talks being successful. But also was a positive session for Chinese assets and assets in Hong Kong. The Hang Seng up over 2% as well. But let's have a discussion on the Chinese data dump overnight. We're joined by Alicia Garcia Herrero, Natixis Chief Asia Pacific Economist. Alicia, I want to start there. What was the Chinese data showing you? Are there still issues going on in the Chinese economy as they try to reorient their economy towards the consumer?
OK, we're going to move on. That is looking like we've got a small technological issue that is going to make doing that interview quite tricky. So we'll come back to that. So 18 minutes to go until we are going to see equity markets opening here in Europe. Let's figure out exactly how we are anticipating that equity markets are going to open. Remember, last week, really choppy. We saw volatility picking up quite significantly. There were cracks appearing in the credit market. It looks like things are calming down as we maybe start this week and figure out exactly where we're going to be going, despite all the gyrations we are watching in French assets. Or actually, I'm not sure there are that many gyrations. Anyway, let's get into a conversation with the Market Live team and figure out exactly how it is seeing the world this morning. Skylar Montgomery Koenig joins us to talk about that. Good morning. Feels like a more risk-on kind of start to the week than maybe we thought we'd get, judging by the action we saw last week.
Yeah, I mean, maybe it's just a Monday morning thing. We tend to be less optimistic on Fridays in the past couple of weeks. What I would say is we had bank earnings last week, the start of the earnings season, a key thing to watch. Those earnings actually came in quite strongly, despite the fact that you had analyst expectations ramping up into them. But maybe more importantly is within this data vacuum that is the U.S. government shutdown, it was a strong signal to the U.S. economy. And there are a couple of things I'll point to. The first is loan growth. That's bounced, and that tells you that banks are not really that worried about credit conditions if they're more willing to lend, but also that households and corporations are confident enough to borrow. And then more importantly is loan loss provisions. And those were at healthy levels consistent with previous quarters. So you're able to absorb losses, but you're not unduly worried about them. And that data also fits with what we've seen elsewhere. So the Fed has some data on household disposable income relative to debt servicing costs, and again, healthy levels.
So everything is fine, is basically what I'm hearing.
I think, yeah, I mean, that's generally what I'm seeing in terms of you get concerning headlines, as in bankruptcies are higher than they were 3 years ago. And that obviously creates some flashpoints in terms of that sounds very worrying. But what I'd say is a few years ago, we were at very distorted levels. So because you had COVID, this massive stimulus, both from a monetary and fiscal perspective, it meant that your bankruptcies were at multi-decade lows. And so we're now just normalizing from those levels rather than seeing something more concerning. And it actually looks like we're stabilizing at a good level now. now, and the delta is improving. And in particular, if you look at business bankruptcies, they're down from a year ago. Yeah. And you'd also just think you're more likely to have a systematic issue on the way up than on the way down, right? Yeah. So we did see some vulnerabilities exposed when the Fed was hiking. SVB is the notable one, but we've had 125 basis points of easing behind us, and we're also getting fiscal stimulus.
Skylar, I'd also think what last week showed us is that fears of a credit deleveraging or credit event really outweigh that of an equity bubble that could have a more meaningful impact on U.S. economic growth. How are you weighing those two risks at the moment, thinking about overvaluations in AI versus these credit fears?
Yeah, I mean, I think about overvaluations in terms of how the market's trading. So we saw that last week and the week before, right? You get more reactionary to headlines because you have valuations that are very elevated levels, and some parts of the market are looking more frothy. So one of those is gold, but I don't think it's unjustified because you have earnings that are coming in quite strongly. So the reason you get shaken is because you worry about growth. Now, that's understandable. You have quite a lot going on in terms of tariff worries, inflation worries, politics worries, but I think you need to recognize it's creating a choppy trading environment. But as news comes in, you need to think about the actual economic implications of that rather than anything else. And that should guide you. And we will actually get some U.S. data this week, so we will certainly be watching that closely.
We're going to get a lot more regional banks this week, though, aren't we?
Yeah, but the ones that came in on Friday
were better.
Were very good. I mean, the loan loss provisions came in lower than expected for Truist Financial. It jumped 5% after those results. Really led the whole sector to turn around on Friday. It might just be that this is kind of a snap worry and we're over. I mean, you think about what actually happened. Zion's had a $50 million write-down, and it caused a $1 billion market cap loss. I mean, it was very out of proportion with what was going on. But that was just kind of reminding us that there is this worry out there that these small one-off events might all start putting into a bigger bucket. Exactly.
Is that so? How big a fear is that going to be as we pass through? We get to the end of the reporting season. If we are starting to see maybe some problems emerging, Jamie Dimon's talking about there are always more than one cockroach. There is always more than one cockroach. Is the market going to extrapolate and say, actually, there are fears about the bottom end of the market? Multiple people at the moment are writing about sort of K-shaped recoveries, that the bottom end of the market is hiding cracks that aren't visible because the top end of the market, in terms of the way that consumers are spending, etc., are hiding those. But you look at the gap between Delta Airlines and the kind of the lower end airlines that cater to the kind of the lower end socioeconomically, big divergence beginning to emerge there. You're seeing in a number of different asset classes. Is that what this reporting season is going to show us, that there is this divergence? There is this K-shape that exists not only within society, the economy, but also the market? Yeah, I mean, that's certainly something that we're seeing. I guess it's just, obviously you feel for people that are in that bottom lower income bucket, but what does it actually mean for earnings and the growth of these companies? Are they the ones that are boosting that earnings method? Are you caring about equities? Are you caring about the income distribution? And you can see that earnings are still holding up well, and that's holding up the equity market. And I think, too, part of what we've seen is you've had 80% of total loans reported so far. So the big banks make up a big chunk of what that lending is, and you do care about overall size as well as who's affected and how that feeds into your asset valuations.
All right, Bloomberg's MLive's Skylar Montgomery, thank you for joining us with your thoughts on the market. So we were talking about credit fears, but there's also a debt fears when it comes to governments as well. The UK Chancellor of Exchequer, Rachel Reeves, gave the clearest signal yet that she will boost her wafer-thin fiscal buffer at next month's budget to put the public finances on a more stable footing. She spoke to Bloomberg's Lisa Abramowitz in Washington.
We will continue to meet the fiscal rules that I set out in my budget last year, and we will get debt down as a share of our economy. We will bring down the deficit, and we will balance day-to-day spending with tax receipts. And when we get the full forecasts from the Independent Office for Budget Responsibility, we will make sure that we are continuing to achieve those things. In terms specifically of the headroom, the headroom has been lower in the past. It was as low as £6.5 billion in the last parliamentary session. Obviously, more headroom would be good, but there's always trade-offs because, of course, to build more headroom, you would have to increase taxes further or cut spending further. But we'll continue to manage that balancing act. But I recognise that in a world as volatile as it is today, having a bit more of a buffer can help absorb shocks.
You've talked about raising the taxes, and in a previous interview you were talking about particularly targeting wealthy residents of the United Kingdom. Is that really the focus right now? Is it broader based in terms of the tax raise you have in mind?
In the budget last year, I did increase taxes on some of the wealthiest, and we also increased taxes on business. I'm very mindful, again, to get the balance right. We want to attract talent to the UK and keep talent in the UK. I also want to make it easier for businesses to grow and stay in Britain. So I'll set out the individual taxes on November the 26th, but I want this to be a pro-growth budget that maintains Britain as a great place to start and grow a business and to bring in investment. And obviously over the last few months we've secured huge amounts of foreign direct investment, including from the United States, with those big technology companies investing in Britain.
There's been a concern that if taxes go up too much on businesses, people will start to leave and individuals will leave, and that there's been some anecdotal evidence of that just personally when I meet people from London and New York. I'm just wondering, have you kind of grown aware of that and tried to reduce how much you lean on that lever?
Well, we made some further changes to the tax arrangements for non-domiciled people earlier this year, which I think have been welcomed. We'll continue to monitor the response to any tax, but I would also say there are many people choosing to make Britain their home. We've just doubled the number of visas available for high net worth individuals, for entrepreneurs, and for academics in some of the growth sectors to build teams in the UK.
UK Chancellor Rachel Reeves signaling her intent to boost a wafer-thin £9.9 billion fiscal buffer. Reeves is set to present her autumn budget next month, actually the day before Thanksgiving.
It's genius timing, isn't it?
Historically, a very illiquid day. So I guess we wish her and the gilt market best of luck.
Yeah, you can compare and contrast France, with the UK, kind of which one is going to produce potentially the shock. At the moment, it feels like France, but actually I'm not seeing that big a shock in the OAT market this morning. There is this presumption still that Christine Lagarde and the ECB stands behind France, and ultimately you will see any problems being resolved. Does the UK have that ability? No, it doesn't, but it does have the ability to drop its currency, and there are other kind of outs. But yeah, I think that's going to be quite interesting to see how she works her way through that one.
Well, I think the key piece is also, you made it in that comment, that they've already started in her last budget, raise the taxes on the wealthy. That's something that's being discussed over in France as well, and something that's actively affecting some of the heavyweights in France and specifically in the luxury market.
So speaking of the luxury market, did you read that Ferrari has cut its supply of cars to the UK on the back of this non-dom change? It was reported in the FT. Again, tying it to unintended consequences of the wealth tax.
So what they're worried about is residuals as well. The fact that residuals have come down as fast as they have in terms of the second-hand market for Ferraris, which is a kind of, because they tend to, you tend to kind of own one Ferrari, then buy another one. But residuals are coming down. So that's kind of...
Is that how it works? I wouldn't know.
Apparently, I'm told. We need to talk about the luxury sector, actually, in terms of what is happening. Chloe Melly's got some details as to what is going on. We should talk... there's the China read across, but there's also this Kering story.
Absolutely. Chloe Melly has all of it. Chloe, walk us through some of the stocks to watch.
Good morning, Kriti. So we've got some big luxury news over the weekend. Kering has sold his beauty division to L'Oreal in a €4 billion deal, and this is part of a broader strategic partnership in beauty and wellness between the two companies. So we could see that boosting the shares in those two companies this morning. L'Oreal has been a little bit flatter, so could get this boost. Kering has seen this massive rally over the last few months, and that could continue on the back of this new deal. This is really seen as Luca de Meo's first big move, big strategic move after joining the company, after joining as CEO of Kering last month. And this was really an attempt at kind of reducing that high debt burden that was seen as a bit of a potential concerns by analysts and investors. So we'll see how the market reacts and digests this new deal this morning at the open. Moving on to the offshore wind sector, Vestas wind system has halted the development of a major factory in Poland that was meant to produce turbines, blades, for wind turbines. It said it halted that development government paused that project because of higher costs. So higher costs because of high interest rates, but also higher costs because of materials like steel. And those higher costs translating into lower demand for offshore wind projects in Europe. So this could weigh on the shares of Vestas this morning. We could see a little bit of weakness, a lot of seesawing up and down, but also that weakness for that general offshore wind sector that, of course, has been quite weak over the last few months. And finally, we're starting the week with some bad news, more bad news for the UK housing market. The bounce in house prices that we usually see in the autumn has not materialized, and that is because of that speculation that property taxes will be increasing at the autumn budget. And so this is kind of creating a wait-and-see approach. So we'll see how this affects some of the key UK home builders. We have got a little bit of weakness, particularly in Barratt Redrow, which is the biggest UK house builder. And of course, the news of this weakness of this lackluster housing market probably will not help at the open this morning.
All right, Chloe Melly, our equities reporter, walking us through some of the stocks to watch. We thank you so much. She hit the luxury space, she hit the UK housing space as well. But if you look overall at futures, I mean, they're bouncing quite hard, perhaps to last week's price action. So
let's just talk about the longer-term picture here and what we've got. Take a look at the long-term picture of the S&P, the E-mini futures, and what you're getting is you still haven't filled the Trump-China gap that we got a week ago, Friday. So we're still kind of crabbing sideways. So yes, we are getting a rally this morning, but on a 10-day basis, we are still in negative territory. So just kind of a bit of context here, I think is really important. Keep an eye on defence stocks as well. That's going to be an interesting story in the market this morning. Maybe part of that narrative pushing stocks a little bit higher today. Anyway, 5 minutes to go until the equity market open. We'll deal with the details in just a moment. This is Bloomberg. A lot's happened this weekend, and we need to think about Friday when we think about Monday. There's a lot to kind of fold in and think about what is going on. Keep an eye on French stocks this morning, figure out what's going on there with this downgrade. But let's talk about the kind of the history lesson of Friday. European equities largely rallied into the close. A little fade as we came through towards the back end of the session. We went out about here for US markets, so we've got a little bit of a rally that we need to price in the back end of the session. But there's lots of kind of single stock sector stories that I think need to be folded in as well. So it's going to be interesting to see how those all price this morning. Broadly, futures are looking pretty positive. Feels like the VIX is down, stocks are up. Feels like a much more front foot kind of a day, Val.
Yeah, VIX had a decent drop on Friday, really leading this risk-on rally to continue into Monday. Euro Stoxx 50 futures are up just shy of 0.8%. FTSE 100 underperforming just slightly, up only 0.4%. We are seeing an outperformance in the DAX. Now, Kriti, a big question whether this is the defense trade leading the gains or perhaps a rebound in the banking sector. Kriti?
Absolutely. Also, just those lofty valuations. I mean, how does the defense stocks react to that? Is it a valuation story? Is it a contract story? Is it a headline Ukraine story? That's certainly something we're going to be watching. To your point, Val. A couple of others in view. Vestas is certainly one of them. It looks like they are warning about a decline in European demand to the point that they're halting a Polish blade factory. Maybe some news that may not be well received when it comes to the open. We also have our eye firmly on luxury. Guy there mentioned some of the political risks coming out of French stocks. Well, it looks like Kering is also in the M&A business when talking about selling his beauty business to L'Oreal. Maybe that's something to watch. Maybe M&A isn't dead in this environment, Guy.
Okay, let's talk a little bit about how this market is going to open. We've set it up for you. Let's see some numbers. Figure out how positive Monday is going to be and which sectors are going to drive it. Time for the opening trade. Let's talk about where we are. We're expecting a positive performance to emerge. The FTSE 100, it's going to be interesting to see how the mining stocks perform. Defence stocks as well. BAE Systems is tied into the AUKUS programme, which is the nuclear story around what Australia, the US and the UK are going to be doing. We'll see how defence stocks trade today. We're up by 0.2. We're up by 0.4 on the stock 600. Could take a while to get the CAC 40 open this morning. It could take a while to get the DAX open as well. We'll see how the IBEX trades this morning. Even it's not giving me much action early on to work with today. But we are expecting a positive performance. There's the CAC up by 0.5%. The IBEX is up by 0.8%, so powering ahead. I am assuming that it is going to take a little while to get the DAX open. So I'm going to hand things over to Val for a sector and stock story.
Let's take a look at how the sectors are opening up. No surprise, the banking sector is at the top of the list, up over 1%, and the biggest points gainer so far on the Euro Stock 600 is a bank as well. HSBC up nearly 2%. So we are seeing this broad rebound from Friday's worries about those U.S. regional banks continue in Europe. Remember, it was a very bruising day for European banks on Friday. We also have technology up there, Guy, at the top of the basket. We only have a few sectors in the red, just 3 of them, one of them being consumer products. That sector is lagging, but a majority of the stocks are up this morning. 350 in the red, only 130 in the green. Wow,
yeah,
it's the wrong way around.
It's interesting that you are getting names like Unilever and Anheuser all moving a little lower this morning, because that's where, if you think about where the market has rotated over the last kind of few days, that's been where we've seen that rotation into the more defensive end of the market, into the safer end of the market. You still need to buy deodorant and toothpaste and all those kinds of things.
Please buy your deodorant, Guy.
I'm going to make sure that we continue. Everybody should take that advice and continue with that, even if we do get a downturn. But it's back to being banks and tech as the big drivers this morning. ASML is the biggest points gainer this morning. HSBC, as you mentioned, Val, is the second biggest. Even Novo is up there as well. SAP, Rolls-Royce is moving up. So the defence trade is back on, it seems, first thing this morning. Or maybe it's a civil story with Airbus rising as well. But it does seem as if some of the defence names are moving up there. Luxury's having a good morning as well. Kering moving positive too. Maybe on the back of the China data, maybe on the back of the deal that it's done in terms of offloading its cosmetics business.
It's your biggest percentage mover to the upside, higher by, 5.5% and moving higher as we speak. Broadly, though, you look at the CAC Iran, I'm not seeing much downside here. It doesn't feel like the downgrade from Friday has really affected the mood when it comes to the French story. Party here in Europe is what I'm seeing.
You'd expect to see it in the banks, and the banks got beaten up last week, so maybe actually one is offsetting the other in terms of the narrative that you're seeing this morning. But it's interesting, it is, in terms of what's moving points-wise, the CAC this morning, it's Airbus, Safran, Kering and Schneider. So tech is in there. You've got some of the defence names, you could argue, but actually Airbus and Safran, that's more on the civil side. But SocGen is in there as well. So SocGen is up by 1.7%. You'd expect a negative story on the French bonds to feed through into French banks. I know that connection's not as strong as it once was, but you're not seeing it. Maybe because banks were already being beaten up.
Yeah, so banks, tech, and defense all really leading gains across Europe this morning. Let's bring in a guest around the table. William Sells, the HSBC Private Bank Global CIO. Thank you for joining us this morning with your thoughts on these markets. Friday, or at least last week, really freaked everybody out for reasons about trade, reasons about credit fears. What worried you this weekend?
So I spent a lot of last week talking to our clients, and there's a long list of things, whether it is the private credit market, whether it's France, the trade side, Fed independence, other things come back. And I also talk to a lot of portfolio managers, and it strikes me that beyond that long list of worries, there is also very little conviction in 2026, especially from a shorter-term perspective. The longer-term perspective is positive, and I do agree with that from a longer-term perspective, you have, a lot of fiscal stimulus, you have the one beautiful bill stimulus that will come through, the SALT treatment, for example, the capex spending, not just from AI, but also because of that capex treatment. And then the consumer, which is in some parts challenged, but in other parts relatively strong. So couple that with some interest rate cuts, and you have a market that will go up.
Yeah, that's been a key point of discussion around the table, at least last week, this K-shaped recovery. We're seeing wealthier consumers do well, and the bottom half of the K may be impacted by Trump's immigration policies, definitely on a back foot. How would you use a Federal Reserve set policy in that kind of dynamic, where you have this, maybe the AI boom, this wealth effect from those holding tech stocks, seemingly outweighing what's going on perhaps in the real economy under the hood? Yeah, so there is this shift from an inflation worry more towards growth worry, and potentially when they need to weigh the entire economy, the entire consumer, they will have sympathy for that weaker part, of the consumer. So I do think that you do get those two interest rate cuts. The entire question is, in 2026, I do think you are going to have volatility in terms of market expectations of how much further the Fed is going to go. You just need to look at the dot plot, and you immediately see that there is that, huge divergence. And again, with investors out there, with our clients, with institutional investors, there's a huge discrepancy. But the people who typically take the view that the Fed is going to do a lot or too much also have a steepening
penciled into the market. So bonds for the moment, and especially quality bonds, can do well, but somewhere in 2026 they are going to run into resistance.
But you talked about that case being kind of based upon the idea of rate cuts coming out of the Federal Reserve and monetary policy. What about here in Europe, where the bias seems to start shifting to, I don't want to say a hike, but certainly not a cut or further cuts? Do you start to see a divergence then between the outperformance of the States versus Europe based purely on monetary policy?
Not just because on monetary policy, but also in terms of earnings growth. When you look at even year to date, what we've seen in the market is the US rally has been mostly driven by earnings growth, whereas in Europe it's a multiple expansion, it's a catch up, and that particularly in the early parts of the year where people actively wanted to diversify almost away from the US. Then they realized that the US is delivering on earnings, and therefore those flows, we're no longer seeing them. Especially for our Asian investors, it's very hard to get enthusiastic about Europe, apart from a number of names that they know very well. So yes, I think you do get the diversions. We therefore have a preference for the US, where there is earnings delivery, and also China and Singapore as kind of that barbell over preference for those over Europe.
So not too hot on Europe. Let's talk about maybe the counter case to that, which a lot of people are saying. If you look at the European corporate market right now, they're actually using the American playbook, which is a lot of share buybacks, a lot of dividends, a lot of return to shareholders, which is attracting flows in places like the financial sector, among others. That's not usually something that European corporates do, but right now that trend has continued. Is that a reason to be bullish on Europe?
I think it's a type of company that you want to look for, but not just in Europe, but across the world, where you have shareholder value creation, whether it's dividends, whether it's share buybacks, whether it's M&A activity, which I don't think is dead, which is picking up. I do think that is a theme that people want to exploit, where you then are a little bit less, exposed to the earnings growth, which is probably less materializing in Europe.
You said you had conversations with portfolio managers and your wealth clients. Do they see the world differently?
So, in particular with our Asian investors, there is more of a worry about the US, and how policy impacts the credibility of US investments. Now, what they typically do, and where they do the same as institutional investors, is they decouple the view on the equity market from the dollar view. So because of the earnings delivery and a little bit of FOMO, frankly, they want to stay into the U.S. market, and I do think that
are they hedging it?
But they're potentially hedging it, indeed. So there is more hedging activity.
So is there hedging? So there's hedging on the dollar front. Is there more hedging as well in terms of taking equity positions?
No, so given that the earnings are going to drive the stocks higher, and especially on the IT side, they continue to be positive.
Is that conviction there, though? What I'm trying to understand is whether or not there is high levels of conviction as to whether or not stocks are going to go high from here, and one of the ways of doing that is, yes, I'll put that position on, but I want to hedge I want to take some more hedging around.
So the hedging of the US dollar we've covered, because they're potentially negative, and that's an interest rate differential conversation with the ECB, for example. On the equity side, there is very much a belief in the medium to longer term AI trade. Now the question is, who are you going to pick there? Obviously, the analyst needs to be super sharp on this, and potentially people are diversifying more, so going into the entire ecosystem, particularly on the infrastructure side, particularly even on the energy side now. People really switching on
some big moves.
This issue about energy shortage, but also, and this is more difficult obviously, is about the adopters, because if you are worried about big investment by the hyperscalers, for example, you can be an adopter without very big investment, right? And actually have a delta and slight improvement in your operations. Those are obviously across sectors.
Yeah.
But across sectors, analysts are more distinguishing between who are the adopters that are going to win and who are the ones that are laggards in each of the sectors.
Well, I'm looking into the end of the year. What's the biggest risk event for you? Some people have mentioned that Supreme Court case when it comes to tariffs that's starting in early November. What could really disrupt your view here?
Ultimately, I do think that the market is probably a little bit too dovish on the Fed side. I do think that will probably, in our court case, probably only materialize in the beginning of next year, that people start to really worry about it. But obviously, that could be pulled forward, and then you potentially have an issue. Obviously, the Treasury yield is very, very far removed from where we think is kind of the danger zone. Yep. You probably need to get close to 4.5, 4.7 on the 10-year before that can start to really, create a lot of equity market volatility. But that is like the more systemic one. I don't think the issues in the private credit market or in, with the two companies that were mentioned who aren't actually private credit, loans. I don't think that is the spiral. That being said, we do have a preference in the bond market for quality.
You said 4.6, 4.7. I'm looking at a 10-year at 4.02 at the moment. If we go in the opposite direction of travel, which is where all the technical trends are suggesting, at what level does it become an impetus to buy U.S. stocks further?
I think you. I would think. I thought your question was going to be when do you take profit on the bond market? On the bond market.
You are welcome to answer that as well.
Because I don't think this goes down a lot further in terms of Treasury yield. So at some point you take profit. That being said, bonds obviously as well as private credit, in my view, are important to get you that income element into your portfolio. On the equity side, I think it's reasonably independent of that bond market movement, given that you are away from the danger zone. It's less correlated to that. And I think that you are a buyer when you start to see a little bit more volatility in the tech side in particular. That is where people have that longer term conviction. But as I would say, I wouldn't just buy the chips. I wouldn't just buy the Max 7. I would really broaden that exposure and even go as far as energy, electricity and infrastructure.
I'm going to thank you there. Thank you very much indeed. William Sells, HSBC, Private Bank, Global CIO. Thank you very much indeed. Sorry about that. Time marches on. Let's talk about what's happening in the core six. Let's start there and figure out where we go more broadly. As you can see, what you are basically getting now is a kind of reversal of this I need to find somewhere to hide out. And Nestlé, to a certain extent, was that position. Unilever was that position last week as the market kind of freaked out a little bit. As I say, you want to go back to deodorant and toothpaste. What you are seeing is a bounce back in defence stocks today, which is important because you saw that stock getting battered last week. Luxury's up a little bit, but not by much. Tech's up a little bit, but not by much. It's interesting to see actually some of the pharma names moving more positively. What else are we watching? Well, let's get back to the luxury sector and figure out what is going on there in more detail. Chloe's here with details on Kering.
Good morning, guys. So, Kering is up almost 4% this morning on the back of its deal to sell its beauty division to L'Oreal in a €4 billion deal. So this is part of a broader strategic partnership between the two companies. Both of them are moving higher on the back of that, although Kering a little bit more. This is really seen as the first big strategic move by the new Kering CEO, Luca de Meo, who joined last month and has been trying to turn things around at that luxury company. And this deal in particular is seen as reducing that really high debt burden that was concerning some investors and analysts. So the market is really rewarding that decision to sell that beauty division, and we are up in the green for those two this morning. Moving on to the defence sector, that is also up this morning. Mostly we've got positive movements at Rheinmetall in particular, up 4%, in Saab as well. This is because the ceasefire in Gaza is looking increasingly fragile. All those companies were down last week on the back of the news of the ceasefire, but now Israel has launched new strikes against Hamas and suspended aid. So that ceasefire is looking a little bit more fragile, a little bit weaker, and this is driving the shares up across that defence sector this morning, except Dassault is quite weak, but apart from that, the rest is up this morning. Moving on to ThyssenKrupp, the steel company is down massively this morning. We're down 23%. This is quite an eye-catching move, but this is actually because of the spin-off of its submarine manufacturing arm, TKMS, which is listing on the Frankfurt Stock Exchange today. So with those kinds of spin-offs, we can expect those massive drops in the shares. We had the same thing with Continental and Aumovio a few weeks ago, if we remember. And finally, B&M is also down massively this morning. The furniture retailer listed in the UK has issued another guidance cut. So it actually issued a profit warning a couple of weeks ago, but it had missed some costs in its outlook. So it had to cut guidance again, and that is not being received well at all. And the CFO also stepped down on the back of that. So very negative moves for B&M this morning.
All right, Chloe Melly from our equities team walking us through some of those early movers. We thank you so much. Of course, we've got one eye on maybe the juiciest story over the weekend. There are a lot to choose from. That, of course, is the heist that took place over at the Louvre Museum. You were looking at a live shot of the Louvre at the moment. We're trying to confirm whether or not it's open or closed, but you can see the crowd still very much gathering after the events of the weekend, guys.
What do you think they want to see? Are people setting up to try and see if there's anything kind of...
Maybe there's someone still hiding.
Well, you never know, or maybe more pieces of equipment have been dropped.
I think it's safe to say it's as beautiful on the outside as it is on the inside. So I'm sure there's still photos being taken. And
I think it's going to open late. I think that probably is it. And I suspect that there are going to be exhibits that would normally be open that may not be open this morning because they're missing a few things.
So we're told.
Anyway, coming up, we're going to talk about what is happening around these markets in a little bit more detail, get a macro top-down picture of what is going on. We saw a big move in volatility last week. We saw a big drop Friday. We've got the credit jitter story to fold in. We'll talk about all of that next. This is Bloomberg.
Welcome back to the opening trade. We're 20 minutes into today's cash equity session, and risk is on a front foot today. Let's say that Euro Stoxx 600 up 0.7%. Some outperformance in the DAX. We were powered higher by banks rebounding, also by defense names rebounding from their slide of last week. The DAX up more than 1%. The CAC 40 in France is up 0.6%, and that is despite an unexpected downgrade from S&P on Friday, dragging down their rating from a AA to single A. We watched the Moody's rating review on this coming Friday for any further update. Euro Stoxx 600, though, is rebounding strongly. Our senior strategist for EMEA equity markets, macro trends and strategy, Michael Masika, writes this morning that while the Stoxx 600 remains higher for the month, under the hood, a sector rotation is underway as investors switch to more defensive parts of the market. He joins us now. What defensive parts of the market are getting the bid? It's obviously defense today, though that's not necessarily a defensive sector.
Well, you've seen over the past few months, cyclicals were really in favor. There's a lot of a very high positioning on banks. Miners caught a bid for the past few months. So it was really risk on in the cyclical side of the market. Mm-hmm. Now you feel like investors, they want to calm down a little bit. Like banks are really up. They're trimming their exposure. On the same side, you have sectors that have become extremely cheap and they're very defensive and they providing very good earnings growth, like healthcare, for example. And that's the one that's getting traction recently. That's what we've seen. As for the market in general, last week you had a big risk-off move from every single cohort of investors, especially in the US, where it's discretionary, systematics, all strategies, they all cut exposure. And they come now to a point when it's actually neutral / even underweight on those. And you can see stocks are getting, bids like they were bid on in the US on Friday afternoon, and it keeps going on this week.
We still haven't fully bought the dip, though, in the US, which I think is interesting. So that kind of narrative is struggling a little bit. If I look at the last 7 days of Europe, we just chopped sideways. Really, we are kind of back to where we started after we saw Trump coming out with that language around what was going on with China. But we haven't made headway since then. What's happening in terms of momentum?
Slowing down, for sure. We have seen this also, the strength of deep buying is slowing down a bit. So investors are getting a bit more cautious. The other thing as well is we're getting into the earnings season. Yeah. So now we're going to see how the Max 7 have been, faring lately during the quarter. Are we going to have a real cyclical bounce in terms of earnings growth? There's also the question of the blackout period, buybacks are stopping. This is the biggest demand for equities on the markets, especially in the US, buybacks. So now they're in blackout period. So, the flows are calming down. So that's why you don't see such a strong buy the deep action, I would say.
Does that apply to European equities too? Because it feels like European equities are still engaging in buybacks and dividends and all that fun stuff.
It's definitely not as strong this action is not as strong in Europe as in the US, but they will also trim down buybacks during the season. I mean, the earnings season in Europe hasn't really started. It's going to start really this week or next week, like properly. So that's what we're seeing.
Nice to see you, Michael. Nice pieces this week, nice pieces last week. We'll look forward to them this coming week. Michael Masika joining us from our macro team. Let's talk about what's happening in the auto sector. Busy still. You've got tariffs kicking in stateside on the heavy truck side of things. You've also got Porsche naming Michael Letters as its new CEO, tapping the German engineer who has honed his luxury car skills at McLaren and Ferrari. He's in to steer the turnaround. Joining us now, Craig Trudell, who leads Bloomberg's global automotive coverage. What does he think about electric motors, and what does he think about kind of engines that make noises, and kind of which way do you think he's going to turn?
Yeah, I mean, I think one consistent thing that you see when you look back at his resume a little bit more closely is, he had a previous stint at Porsche. While he was there, worked on a hybrid version of the Cayenne. Goes to work for both Ferrari and McLaren, and while he was there, both of them follow Porsche's lead with introducing SUVs and also introducing hybrids. I think, sort of putting that all together, I think, looking at what Porsche has tried to do, I think, as part of the Volkswagen Group, there was this sort of assumption of, okay, electric vehicles are going to be more expensive than combustion cars for the time being. Therefore, let's focus our electrification strategy on our high-end brands. But that has not worked out well. There maybe needs to be some differentiation between, say, Audi's electrification strategy versus Porsche's, and some questioning as to whether or not the Porsche buyer is really interested in making this transition and being on sort of the front foot versus some other brands within the portfolio.
And Craig, this seems to be a theme every week of another auto company retrenching on its EV plan. Do you think at least Porsche is vulnerable to a repricing if this new CEO does make a big statement?
I do think we've kind of seen this in the works already ahead of him even coming in, where we've seen the company, come right out and say, look, we're going to take the hit and take write-downs on electrification, projects that we're abandoning. I think we will see this brand lean into hybrids, and also, it has sort of laid some bets going back years on alternative fuels. I think the question, of course, is can you execute better on this new strategy than you did on full electrification, and especially on the alternative fuel side. On paper, it sounds great, right? Just a sort of drop-in fuel for existing models where you have an awful lot of investment and, sort of capacity baked in. Just switch over fuels, but executing that has been a real challenge. And Porsche has stood up some, at least small bits of production of alternative fuel, and yet the output is tiny and a ways from actually being feasible.
And the tariff overhang, of course, something that always lingers over the sector. Bloomberg Global Autos editor Craig Trudell, we thank you so much. Coming up next, we dive into the credit sector. Stick with us. This is Bloomberg. Welcome back to the opening trade. About 30 minutes into today's session, green on the screen across the board, across the continent. Your outperformers right here. It's the DAX, higher by 1.2%. Tech and defense having a good day. But you know what really strikes my fancy is the CAC 40, higher by 0.7%. The downgrade, the risk overhang from the political situation, not really making a dent. Maybe the M&A story rescuing that market. But, Guy, from my perspective, everything's fine this Monday morning. Yeah, I think you've got to look at it in the context of last week. Certainly feels better than it did then. Let's talk about the market internals. 447 up, 140 down. That's the narrative you're looking at. So a positive picture. What was interesting, though, is when we were on the downside last week, volume was good.
Volume was way above average last week. What you're now seeing on an up day is actually volumes a little on the light side. So maybe that tells you something about what is happening here as well. 52-week highs, let's talk about it. Kering is back with a bang. And look at Mayo's latest strategy appears to be delivering for shareholders. We're up by nearly 40% over the year. There's been a big trough, obviously, within this chart, as you can see. But it looks like actually the strategy beginning to gain traction. That stock at a 52-week high today. BME, more bad news coming through in the retail space for A, the sector, and B, this stock. And as you can see, that stock is being punished. Again, K-shaped recovery. Luxury at one end, not so luxury at the other end. That's the narrative we're again watching here in Europe, Val.
Well, here's what else you need to know this morning. Japan's Liberal Democratic Party leader, Sanae Takaichi, has moved closer toward becoming the first female prime minister. The ruling LDP is expected to sign a coalition deal with Japan's Innovation Party later today. The pact would still be 2 seats shy of a majority, but opposition divisions mean Takaichi would be all but certain to win a parliamentary vote to decide the next prime minister. The Israeli military says it will return to enforcing the ceasefire in Gaza after carrying out airstrikes on Sunday. It says they were in response to an ambush by Hamas in which 2 Israeli soldiers were killed. Palestinian officials say 27 Palestinians have been killed by Israel over the past week. Israel has also halted the transfer of aid into Gaza until further notice. And finally, S&P has downgraded France's sovereign credit score from AA- to A+. The unscheduled move highlights the nation's fiscal woes and places its debt at risk of forced selling by some funds. France has now lost its AA rating at 2 of the 3 major credit assessors in little more than a month. Kriti?
An unexpected twist and turn on the French story. Let's get a little bit more context out of France by this. We're joined now by Jean Dalbard from Bloomberg Economics. Jean, an unscheduled move by S&P. What prompted it?
I mean, it was really surprising, honestly. I don't see any reason why S&P shouldn't have waited for its next regular review, which is scheduled to be in 1 month's time. So it was really surprising, the timing, but the downgrade was pretty expected given the political deadlock that we see in France, which threatens the fiscal consolidation next year.
In terms of what happens next, we're now looking forward to what we're going to see Friday. Is there anything between now and then that we are going to get from the French government that will avoid another downgrade?
I mean, downgrade from Moody's is a key risk for the French situation, but I don't see any new events from today until Friday that could trigger like a surprising move from Moody's. The downgrade the cut from Moody's is expected as well, but there is nothing specific scheduled on the agenda that could trigger something like ahead of the rating review scheduled on Friday.
All right, thanks to Jean Dalbard from Bloomberg Economics on the latest out of France. Switching from sovereign to corporate debt, Carlyle Group CEO Harvey Schwartz told Bloomberg's Danny Berger that recent volatility in the credit markets is a concern.
That data suggests that companies are growing, employment is steady, inflation's a little sticky, but there's nothing in the immediate horizon that suggests that, as you would say, things are crumbling. Having said that, late cycle, it should be on a worry list.
For more on this and wider markets, we're joined now by Andrew Sheets, the global head of corporate credit research at Morgan Stanley. Thanks for joining us this morning, Andrew. A lot of attention on the credit space last week. Do you think it was overblown? Because the markets are clearly telling us this morning it was overblown.
Yeah, we think the market may have overreacted a little bit to what was going on last week. And look, to take a step back, I think the market was seeing a lot of things that understandably could drive concern. Spreads are very tight. You're seeing a very aggressive capex cycle in the AI space. You saw a large LBO. You saw, I think, some weakness in the alternative asset manager equities. And all of that combined with some unexpected losses in certain regional banks, I think, added to this idea that the market is being complacent to risk and maybe overlooking some risk. But I think if you actually walk through those issues, they look less concerning to us. And I think the credit market, rather than being complacent, has actually been quite aggressive all year in tiering credit in providing a pretty high penalty for poor performance, for being CCC rated. And I think that suggests a market that's a bit less complacent than maybe was made out to be last week.
So there are signs in the credit market that we could be in a late cycle, as many market participants mentioned last week.
So our view is that you're seeing some of those late cycle signs, but it's actually much more likely, I think, that this cycle runs longer and burns hotter than I think the market's expecting. I think some of the concerns last week was, okay, we're seeing some signs that this kind of might be peaking out. And rather, I think in our view, with the Fed set to cut, with easy fiscal policy, with easing regulatory policy, not to mention an enormous CapEx cycle that's still coming down the road, this is all, I think, energy to drive a much more aggressive phase in the corporate cycle than we've seen so far. So that would drive the cycle going for further.
So we're still warming up. We're not cooling. We're not late cycle. We are definitely not late cycle.
So I think that suggests exactly that the cycle has more aggressiveness to run. And if you look at, say, M&A activity, right, it's still below average if you adjust for the size of the economy, which is not what you would expect if we were really at that kind of late cycle peak.
If the Fed's worried about employment, if the Fed's worried about kind of what is going on in terms of the labour market, shouldn't there be a connection between what is happening in the economy and what is potentially happening in credit? If credit's still got a lot further to run, why am I worried about the economy? There appears to be a sort of gap here.
So I think this is what's so interesting about the Fed's view, because I think the Fed has made it very clear, even though inflation is above its target and not kind of really coming down recently, there are worries enough in the employment space that argue for easing. But if you look at Morgan Stanley's forecast for third quarter GDP, we're tracking third quarter GDP at 3.5%.
Yep.
Inflation's probably about 3%. So nominal GDP is 6.5%.
That's nice.
So, and the Fed is set to cut, and the Fed is set to cut, we think, 5 more times. So
the credit market's right and the Fed's wrong, do you think?
I think that what the Fed is trying to make a probability-weighted argument. The Fed is, right, all of monetary policy is about skews of risks.
Sure.
And I think the Fed thinks, look, the risk of us getting the unemployment rate side wrong is much greater than if we miss on inflation a little bit. And maybe some of the inflationary pressures are temporary. But if that's the Fed's skew, then I think that ignites, or that creates the probability, a higher probability, that credit markets will run further. Because if the Fed is running easier policy into already easy fiscal policy, into easier regulatory policy, that should drive more corporate risk.
But the Morgan Stanley view is that the Fed's wrong?
No, the Morgan Stanley view is that the Fed...
You're talking about a very aggressive economy here already, a hot economy, and they're going to juice it.
Well, what we think is that the economy will show some slowing in the coming quarters, and that will make it a little bit easier to justify the Fed's position. But again, there's a lot of uncertainty out there. And I think this is, if the Fed errs on the side of caution, that creates greater probabilities that corporate activity can go for further.
But Andrew, it feels like so much of the fund flows into credit, although it's in the face of all this optimism that you've just laid out. It's also in the face of corporate credit is looking more reliable than some of the fiscal sovereign options. That's the thing we've seen here in Europe. Would we see as aggressive of a boom in corporate credit if France, Spain, Italy, UK had more control on their finances?
It's actually kind of an interesting question, because I think exactly to that point, the conventional wisdom is a better sovereign piece should be better for credit. And I think you can make the argument that in some ways in both the U.S. and Europe, credit has benefited from more uncertainty in the kind of the competing assets for high quality, right? If you think of the U.S., on the government side, you've got this large fiscal deficit. On the mortgage side, you have uncertainty about what's going to happen to Fannie and Freddie. Maybe that helps corporate credit. And then here in Europe, with Germany issuing a lot more paper, with France facing lower ratings, corporate credit can come out and say, look, we're more stable, we're more predictable, and the realized volatility of credit has been quite low. So I do think that's actually very important. And, again, I think if we go back to the underlying drivers of credit demand, it's not the spread, which is low, it is the yield, which is still elevated, and the volatility, which is modest.
Are we due then for some sort of unwind? If this is such a popular and frankly crowded trade, are we due for an unwind, and what's the catalyst to that?
Yeah, so at the moment, I would say no. And part of that is I don't think we've seen the type of leverage go into the credit space yet that would be the catalyst for that sort of unwind. Now, what would worry us is, as we were just discussing, I think a lot of that demand is yield driven. So if the yields were to go a lot lower, then those flows could be a lot weaker than people expect. So I think that means that spreads and yields will move in opposite directions, that they'll diversify each other. I think if you're a credit investor running somewhat long duration, makes some sense. I think that hedges the scenario where your demand is most likely to disappear.
Andrew, I read that your latest note said that there is a Goldilocks scenario for European credit. You seem quite positive on the asset class. What's behind that view?
Yeah, so I think if we were to think of it as a stock, and we often think about factor investing, like what are factors you want in a stock? You want a stock with positive momentum, you want a high yield, you want good fundamentals, you want low volatility. I mean, if we think about European credit along those factors, it has a lot of pretty attractive factors. The yield is still high. The momentum is moving in your favor. Those yields are coming down. You're not having to fight a trend. The fundamentals are good. Growth in Europe is modest. The ECB and the Bank of England have maybe been a little bit more conservative in their rate cuts than the Fed has been. But we think they will ultimately continue to cut. So you have improving yields relative to the cash rate. And, the volatility is still quite low. So you have an alignment, I think a really unusual alignment of factors there behind the asset class that are quite good and quite attractive and on our forecast still persist for a little while.
How is that impacted by what's going on in China? We just had some data out overnight, which GDP showed the weakest this year for at least Chinese growth. It does sound like they're having an issue with consumption. Does that impact these European corporates that you track?
So it does have an impact, although I do think here there's a little bit of a divergence between the European equity story and the European credit story. So on the European equity story, we are a little bit more cautious. We have less upside, say, than in the U.S. And part of that is we have a stronger euro on our forecast, and that hurts the earnings story. And some of that is some of the risk out of China-related earnings where our equity strategists are a little bit more cautious. But those China-focused sectors are a smaller part of the European credit market, and the euro earnings headwinds, I think, matter a little bit less to the credit story. So, again, I think those are both issues that certainly matter here in Europe, but are maybe a little bit less of a headwind when we think about credit.
Yeah, I guess I was trying to think that if there was a cockroach in Europe, in what sector could it possibly be in?
There's
autos.
It could be in the auto sector. I think that's quite well recognised, though, isn't it? You do wonder kind of what else could be happening out there. China-related stuff could be a factor. But, I just kind of the potential for a European govy blow-up and kind of how that would feed back in, maybe one of those narratives. Is Europe a diversifier?
I think so. And I think if we go back
to kind of...
Well, I think if we think about monetary policy in Europe, I think you could actually argue that the ECB, the Bank of England, are taking less risk. Inflation is coming down on our forecasts. Growth is modest. These are central banks we think that will continue to cut going forward. So, if I think about our scenarios in the U.S., they're much more binary. It's much wider range between a scenario
where
the
Fed's taking some risk here.
I think the Fed is, and I think the Fed is presented with risk, right? Because again, you have these widely divergent views of kind of where the underlying economy is, and a lot of official data is shut off, so we can't see it. Whereas I think the economic scenarios in Europe are narrower, and I think that's helpful from a perspective of diversification.
How would you? You sound like you've got some tail risks in the Fed scenarios. How would you handicap those? What is the potential for the Fed to get it wrong, i.e. to juice the economy too much, it to become too hot, to maybe on the other end of the spectrum not cut enough into a labour market that is clearly weakening underneath the... How significant are those risks in terms of the tails that you're looking at?
So I think this is a theme that's very important for our rate strategists. Our rate strategists are quite constructive on positioning for more Fed rate cuts, even more Fed rate cuts than we have in our forecast. And their thinking is that the skew of those outcomes, what the Fed would have to do if the labor market is actually a lot weaker than we expected or continues to weaken is quite significant relative to where they would be if growth is modest. And I think there are a number of scenarios as well where even if growth remains strong for now, the markets could believe it's still going to slow in 2026. They don't have to start hiking by any means. They could just stop their rate cuts or sit down. So I think those are things that we think actually still support a steeper curve in the U.S., support steepening between, say, the 3-year point and the 30-year point, and a reason our rates team likes positioning for more rate cuts.
Does housing matter right now?
So it does, and I think that the administration is clearly looking at ways to try to get the housing market in the U.S. moving. But it's difficult because the mortgage distribution is also very skewed. You have a lot of mortgages above 6% and a lot of mortgages below kind of 3.5%. And so we think you'd actually have to lower rates quite a bit to get a lot of refinancing. But we do have to look out for potential policy moves with Fannie, with Freddie, with things to move the housing market. And, again, these are one of the challenges that the Fed could face is that the consumer has been spending quite a bit still so far.
Upper-end consumer.
The upper-end consumer. But if the housing market starts to rally and come back, do you drive even more spending into what has already been a pretty strong upper-end consumer picture?
All right. Andrew Sheets, Global Head of Corporate Credit Research over at Morgan Stanley, answering all of our questions. We'll have him back if there's some sort of crash. Coming up on the program, we check in on defense stocks. President Zelenskiy calling for a freeze in the war in Ukraine to allow those peace talks. What does it mean for a sector that is rallying this morning? Stick with us. This is Bloomberg.
If we want to stop this war and to go to peace negotiations, to urgently and in diplomatic way, we need to stay where we stay, not to give something additional to Putin because he wants.
That was, of course, the Ukrainian President Volodymyr Zelenskyy on NBC. This after his White House meeting. He's urging a freeze to the current battle lines before any negotiations take place with Russia. That was a tense meeting, we understand. The FT is reporting that story this morning with President Trump. They were expecting tomahawks. They didn't get tomahawks. In fact, what they got was quite a hostile meeting. Defense stocks this morning, after a really bad week last week, are bouncing back, as you can see. Most of the names are up this morning. As you can see, certainly Rheinmetall is having a much more positive day, up by 4.3%. But you've got to remember around all of this that the Russian President Vladimir Putin is demanding that Ukraine basically surrender full control of Donetsk. It's a condition. That's his condition for ending the war. President Trump is planning to meet Putin in Budapest sometime in the next couple of weeks. I don't think actually we've got the details of when that is going to be taking place.
Aren't you concerned that maybe the Russian president is trying to buy himself more time?
Yeah, I am. But, I've been played all my life by the best of them. And I came out really well. So it's possible, a little time.
Is your gut
it's all right. But I think that I'm pretty good at this stuff. I think that he wants to make a deal. I made 8 of them. I'm going to make a 9th.
The president speaking about the outcome he anticipates when it comes to Ukraine. A peace deal will get done. Jerry Doyle, our global defense editor, joins us now. Look, what I'm trying to figure out is why we're getting the volatility of defense stocks. We've got this upcoming Trump-Putin meeting. Yeah, maybe that produces something. But the expectation is that Europe is going to continue to spend an awful lot of money on defence. And that is what is basically filling the order books of these big-name defence companies here in Europe. Why are we getting the volatility? What is it? Does the geopolitics justify the volatility we're getting in the stocks? Stocks which should, in theory, not be that volatile.
I don't think it justifies it. I think the reaction we saw last week was sort of an in-the-moment thing, that sudden burst of uncertainty. There was the expectation that Zelenskyy was going to go to Washington, that there would be maybe tomahawks on the menu for him. Then Putin called first, and then everything sort of unraveled in an unexpected way. It's that unexpected outcome, I think, just gave people a little bit of the jitters. But as you noted this morning, the shares were up. And I think the underlying reasons for Europe to rearm, to continue spending on defense, have not gone away.
Jerry, it seems like the timeline for ending the war in Ukraine, Trump really wanted to do it right out of the gates. It's obviously taken a bit more time than expected and still a lot of uncertainties. How does this longer timeline affect Europe's aim to rearm Ukraine?
In terms of arming Ukraine, I mean, it does give Europe more time to produce the sort of weapons that Ukraine needs. But I also think the longer the war in Ukraine draws out, the more convinced European leaders are that they need to spend money on defense for themselves to rearm their own militaries and sort of make sure they have the tools they need to protect against aggression.
When we are evaluating some of these stocks and some of these companies, some of these contracts, are there specific kind of buzzwords that we're looking for in terms of the weapons or in terms of the certain systems that are at play here?
Well, I mean, the ones that are most crucial for Ukraine are things like armor and artillery. The things that are sort of most buzzy and crucial for Europe are the things they can't easily produce themselves. That's high-end air and missile defenses, space capabilities. Those things take a long time to develop. They have require an enormous amount of investment, and it's a much bigger picture there.
This is going to require detail. Do you think we're going to get any detail in terms of the peace plan being put together? We're already struggling with what's happening in the Middle East, and that was a 20-point plan. What is your read on the current lie of the land in terms of turning where we are on the battlefield into a potential deal that could sustain?
I don't think there will be many details because I don't think there are actually many concrete details on the table. Zelenskyy wants to freeze the conflict in place. Yeah. Putin wants to secure a much larger piece of Ukraine as being Russia's, despite them invading and taking that territory. And I think Trump just wants the war to end so that he can take credit for it. So in terms of details, I don't think there are many at the moment, other than, Ukraine wanting to end things as fast as possible.
All right, thanks to Bloomberg's Jerry Doyle, our global defense editor, on the latest in between Trump and Ukraine. How can it possibly affect European defense stocks? Let's get you set up for your trading week. There are a lot of risk events on your horizon. We do get a small shred of U.S. economic data. Today, Trump is welcoming Australia into the White House. Also, China's fourth plenum has begun out in Asia. Tuesday, we get Netflix earnings. Wednesday, UK CPI and Tesla earnings. Thursday, the EU leaders meeting. Frozen Russian assets are on the agenda to be discussed. We also get earnings from Intel. And Friday, we finally get some U.S. data, U.S. CPI, the delayed release.
It feels like the week's kind of slightly backloaded, doesn't it?
It is.
Like in terms of the risk that the market is going to be running. So a couple of days, take it easy, wait and see what happens.
Plus, we have to wait for the weekend for Scott Bessent to meet his Chinese counterpart in Malaysia.
See how that goes?
Yep.
So there's a lot going on towards the back end of the week. I just wonder, therefore, in the meantime, in the absence of news, is the market's predisposition to rally, to go risk on? Kind of feels like it this morning.
It kind of feels like it because you have the defense tilt as well. And I think in that week book that you just kind of outlined, we didn't even talk about, yes, there's the meeting between Australia and the United States today in Washington, but there's a potential meeting, a potential Putin summit as well. And I believe some of the logistics are being organized there in Budapest. So we'll see if that even moves the dial. Of course, we have one eye on the geopolitics in the Middle East as well. And if that's something that's actually tradable, I don't know.
Do you trade the rare earth story into the Australia meeting? Yeah. Wow, some of those stocks have moved over the last couple of days. The 1 month charts are sensational.
Yeah, is Australia the key for America's rare earth independence, shall we call it?
Or at least a bridge until America can figure out exactly what it wants to do on its own territory.
Wonder what Australia wants in return.
Well, it's got this AUKUS deal, which is in place at the moment. I have actually you hear some soundings out of Congress about concerns about whether or not that should be pushed through, whether or not actually the US should focus on building its own submarines for its own fleet. But at the moment, it looks like that deal is still hanging. So the Australians would like to see that obviously being cemented and continuing.
And we got to remind ourselves, we have a U.S. government shutdown still continuing. Yeah. What day are we on?
Heading for a record.
Count. I mean, headed for a record, exactly.
We're on week 4. But it might be as simple as maybe it's just the tech earnings that matter. Maybe that's the answer. Of course, we should tell our global audience the Bloomberg Tech Summit is taking place in London tomorrow. We're going to be examining the future of Europe's tech sovereignty among the industry leaders. We'll be speaking to the CEOs of CoreWeave, Pigment, and Helsing. Lots going on this week. Lots going on in the tech space, the defense space. We will keep you apprised of it all. That does it for the opening trade. The Pulse is up next. This is Bloomberg.